Learning with Dr. Shivangi. Today's topic is stock indices. As in the previous videos, we already started the playlist for the subject business environment and also discussed various topics related to it like concept of business environment, economic policy, 5-year plans, Sensex, and so on. So in today's video we'll discuss about the stock indices. You can also watch other videos, links are provided in the description box. So before I started the video, I want to say you that if you like my video, please like and share this video, and don't forget to subscribe my channel, which is Learning with Dr. Shivangi. Now coming to the main topic, which is stock indices. So what is the meaning, what is the concept, objectives of stock indices, we will discuss here. An index is a number that represents the changes in a set of values between a base time period and another time period. So for any type of index in the related to market value, market performance, there is a base time period and the another time period for the comparison of the index value. Similarly, a stock index represents change in the value of a set of stocks which constitute the index over a base year. So basically stock index represent the changes, comparative change in the value of set of stocks of the companies. Sensex and Nifty are two major stock indices of India, representing Bombay Stock Exchange and National Stock Exchange, where Bombay Stock Exchange is BSE and National Stock Exchange is known as NSE. So these are the two major stock indices of India. Just as a thermometer measures the temperature of a person, a stock index determines whether the market is old or feverish or perform better. This enables the investors to know the market trend and the direction in which it is moving. So basically, stock indices determine the value, determine the performance, measure the performance of the market in any country. Basically, there are two main objectives of stock indices are: first one is to reflect market direction, second is to indicate day-to-day fluctuations in the prices of scrips. So it as we already discussed, that it determines the value, it determines the performance of the market, it shows the direction of the market, whether it is growing or not, it indicates the fluctuations in the market also. The utility of the stock market index in a positive relationship with return to different securities. The BSE Sensex consists of 30 selected stocks and the Nifty consists of 50 selected stocks. So Bombay Stock Exchange is a group of 30 companies representing their performance, and the Nifty consists of 50 type of company, 50 organizations to representing their performance in the market. Most of these companies are blue chip companies having a very good track record. As they are actively traded, the index shares have a very high liquidity. So BSE and NSE both represents the performance of the different types of companies included in them. A stock market index is created by selecting a group of stocks that represent the whole market or a specified sector or segment of the market. An index is calculated with reference to a base period and a base index value. Stock market indices are useful for a variety of reasons. Some of the reasons are described in the upcoming slides. So basically, a stock market index is created to show the performance of the group of companies in the whole market or related to the specified sector with reference to the base period or base year. So what are the basic reasons for stock market indices? First one is they provide a historical comparison of returns on money invested in the stock market against other forms of investment such as gold or debt. They can be used as standard against which to compare the performance of an equity fund. So basically stock indices provide the performance of the companies with comparison to the base year historical comparison. It also shows the performance of equity fund of the companies. It is the lead indicator of the performance of overall economy or a sector of the economy. Stock indices reflect highly up to the date information, and modern financial applications such as index fund, index futures, index option play an important role in financial investment and risk management. So stock indices represents the performance of the companies in the market. So this is all about the stock indices. I again summarize all the points so that you can easily understand about the topic. So what is the concept of stock indices? Basically, index is number representing the performance of the companies comparing to the base time period with the another time period. It is group of companies. There are basically two indexes used in India, which is Nifty and Sensex, representing Bombay Stock Exchange and National Stock Exchange, NSE and BSE. Basically, two main objectives of stock indices, which are to reflect market direction and indicate day-to-day fluctuations of the market. BSE Sensex consists of 30 stocks and Nifty consists of 50 selected stocks. Most of the companies are performing better in these stocks. It is useful for a variety of reasons, like it shows the historical comparison of returns, compare the performance of equity fund, it reflects highly up-to-date information, and so on. So this is all about the information of concept of stock indices. If you have any query about this topic, or if you want to know about any topic related to research methodology, business management, business environment, you can ask me through comment box. If you like my video, please like and share this video, and don't forget to subscribe my channel, which is Learning with Dr. Shivangi. We'll meet in the next video with new topic. Thank you everyone.